Hello YouTube, welcome back to another video. Today we're going to be talking about how the stage is set, and what I'm talking about is this quarterly chart where every candle represents 3 months worth of trading. What I'm going to be watching very closely are going to be 3 levels. First level we're going to watch is going to be the yearly low at 362. Second level we're going to be looking at is going to be 384, which is going to be where we are negative 20% off the highs. That's that negative 20% here. So that's going to be our negative 20. Yes, my writing is terrible. So that 384 is going to be our negative 20%. And then finally, I'm going to be watching here at 410.64, which is going to be our low going back to Q1. We are now staging the worst start to the year since 1970, maybe even sooner. So where we're going to go from here is going to be really important. And what I want to focus on next is just going to be this 384 area, because what that basically signifies is that the S&P is still in bear market territory by being negative 20% off the highs. If we're able to bounce above that area, it means that we will be exiting bear market territory, but we're definitely not inside a bull market. So what does that mean? If we look to the underlying stocks, which make up the SP 500, we note here that the biggest blocks are going to be on the left. That's Apple, Microsoft, Google, Amazon, Tesla, Berkshire Hathaway. And the biggest blocks are all negative 20%. I'm talking about the trillion-dollar companies. So Apple, negative 22, Microsoft, negative 23, Google, minus 25, Amazon, minus 35, Tesla, minus 36. And if we're going to see the S&P exit that bear market territory, what I would really like to see is some of these stocks actually leading it, meaning Apple, Microsoft, Google. I would like to see them exit bear market territory before the S&P to show us that they are still the leaders of tomorrow. We're going to make today's video quite a bit shorter just because I'm not at my ideal setup. So we're going to push forward, but hopefully you enjoyed today's video, and I wish everybody a terrific Canada Day long weekend and July 4th long weekend. If you wouldn't mind smashing the thumbs up and subscribing to the channel if you were new here. We talk about stocks and everything else every single day. So hopefully you enjoy that, and let's go forward. So when I say the stage is set, second thing I'm looking at here is an hourly chart on SPY. So what I'm looking at here is that we have a pretty dominant pattern. It's down. So we have this blue funnel here, which shows us that we've mostly respected the range. I've adjusted the trend lines where we're a little bit below, a little bit above, but for the most part, we are inside. This is going to be notably important because as we look forward here to Friday's price action, we can note that we're building up steam into the close, and we're not going to be open on Monday, which means that as Asia and Europe trade, when we come back online on Tuesday, if we are above that 50 moving average, we could snap up to the 200 no problem. And also, are we going to get a chance to stop going down? Every previous time, it's been a trap. So watching really close to that, watching really closely, because as we noted here, we're currently at 381 or just above that 380.54 pivot. If we can make it back above 384, that means that we are going to be above this downtrend, and we're going to be starting to potentially go up. Also notably important because as we look here to the daily chart, there was some interesting price action that came in on Friday. So we punched it into the closing at the high, and we actually had green volume dominating roughly the last 2 weeks here. So what this signifies to me is that we are attempting to go up by printing a higher high and a higher low and closing above Friday's high, Thursday's high, apologies, meaning this candle right here. That is quite bullish. We're going to have to see that follow through. But what I notice is that the DAX, or the German market, we can note that it did actually also close. Did it close above the high? 12,811, 12,813. Look at that. It actually closed above. So we see that same pattern forming here where we close above the previous high. It looks okay. All right. So since today's video is going to be quite a bit shorter, let's actually jump forward to our news for the week. So key economic data points for this week include Wednesday, the 6th at 2 p.m., where we're going to have FOMC meeting minutes. This is going to be a recap of the June meeting where they raised by 75 basis points. On Friday, we have a really important data point as well. This is going to be payroll Friday. We also have ADP non-farm payroll coming out on Thursday, but since they are going to be changing the way they report their numbers, I am not including that this week. We can also note that the rest of the month is very important, with CPI coming in the following week. We got the 14th, which is when earnings season kicks off officially. And then we have that FOMC meeting on July 27th. What's really interesting here is that as we look forward to the FOMC meeting minutes coming in on Wednesday, we have some Fed speakers this week. Who? Williams, Waller, Bullard, and Williams. Speaking when? On Wednesday, Thursday, and Friday. So Williams going to be there speaking before those minutes come out on Wednesday. And then we're going to have Waller, Bullard, and Williams all talking after. When I look at these names, what it tells me is, again, Williams twice. He's part of the Troika. He is a proxy for Powell. And we heard from Powell this week. So do we hear anything different from Williams? Waller and Bullard are definitely the hawks, and I'll be paying close attention to whether or not they have any change in rhetoric or in tone. Meaning, do they regurgitate the same thing they've been saying for a while, or do they start to finally dial back? That's important because we were talking about the Fed put last week. I'm going to go through a couple of articles here, all shared in Slack if you want to read them after, and then a few more things, and we're going to look at some charts. So we got Mr. Mike Wilson over at Morgan Stanley telling us that the bear market is not over. And again, worst half since 1970. He's looking for, I believe, 15 to 20% more downside from here, which aligns with a lot of our bear market targets. I'm watching really closely at 350, which is our 50 monthly moving average, our 200 weekly moving average, and our 2020 highs. Mohammed El Arian from Allianz is telling us that he is concerned, right? So what's he concerned about? He is worried about liquidity as issuance falls. Here he's talking about bond issuance. And again, we're talking about liquidity. We're currently in a quantitative tightening environment, which means that we're removing liquidity. So if we're already having liquidity issues and we're going to start having less issuance, this could spell disaster for the markets. Liquidity is desperately needed. Moving forward to the next one, which we're going to look at in a moment here. This is the Atlanta Fed GDP tracker shows the U.S. economy is likely in a recession. Yikes, that doesn't look all that good. Next one we got here is, again, I listened to Larry Summers. He's on Wall Street Week. That is from this interview here. You can go and watch that after. Also, what do we have here? Right, fade the rally. So ETF traders sell during the latest equity bounce in departure from earlier this year. So as we look forward to that potentially being in a recession, that could definitely create a second leg lower. And what's really notable here is just that when we go back to the beginning of the year, again, looking at the technical chart, we can look here at a monthly chart, which we did on Friday. We note that dip buying, dip buying, dip buying, dip buying, dip buying. They've been dip buying all year, ever since December, actually. So now the question is there a change in the way they are actually managing those dip buys? Answer is yes. So as we go back to here, again, looking at the beginning of the year or in January, that first rip, 5.5 billion in inflows. In March, we had 42 billion in inflows. In May, we had 30 billion. And then in June, as we went higher, we actually saw outflows. What does that mean? People are locking in losses because this is at the low of the year. So people are locking in losses finally. And we note that from previous videos. There was $1.1 trillion in inflows at roughly 428 on SPY. With S&P currently at about 380, what are they locking in for losses? Well, 381 divided by 428 minus 1, they're locking in about 11% loss. That's not all that bad. But again, there is a lot more than 10 billion which needs to get out. There's more than 100 times more. So if we're going to find overhead supply at the previous lows, what is that telling us? Well, what was previously support is now turning into resistance. That's really, really, really important. Also from Mohammed El Arian here, we're looking at proportion of earning forecasts that are upgrades. And we can note here that it's dipping below. What does this mean? We're getting a lot less companies that are being upgraded as a forecast into earnings. And we noted that those earnings season kick off in about 10 days. So it's getting pretty close here. It's getting pretty close. This is also from my Twitter. So again, looking here, earnings recession on deck. And as we're set to kick off earnings season, it looks like we're already in some trouble. Why? Corporate margins versus consumer sentiment. So that number that came out, I believe it was on Tuesday, is what drove the market lower. And this is just one metric. We note here that the University of Michigan consumer confidence is the red line, and the Russell is the white line. We can note that going all the way back to 1995, there's not been more divergence for a longer period than we have right now. So we can note that corporate margins are at a record high. However, consumer confidence is at a record low, all-time low. So this doesn't look good. And Goldman followed up shortly after. This is on, I believe, May 31st. U.S. profit margins estimates are too optimistic, Goldman strategist says. This is not looking good. Also looking here, we can chart the global economy. Again, factories slow down in US and Asia. So we can note here that there's been also some interest rate hikes around the world. I want to focus on a couple of data points here specifically though. Took some screenshots. So again, read the article if you want to see everything. So again, Britons are more pessimistic than at any time in at least half a century. Again, that same period going back to 1970 where we had the worst start to the year. And again, you can pause the slide here if you want to read it. It doesn't look all that great. We also note that the stock market is the first market which gets feedback. The other ones would include, housing after that. So the housing market, here we can note that expecting less. In the biggest metros, home sellers are slashing prices to attract buyers, which means that transactions are happening at the bid, no longer at the ask. So we can note the percentages here too, right? Yeesh, right? That's a big decline. Right, that's a pretty big decline, up to -30 or more. We can also note here that spending slump. Inflation-adjusted spending fell in May as inflation remained elevated. This would make natural sense when we look at the consumer confidence where, they're feeling a pinch. They're definitely feeling it. First decline this year. So it's the first time we actually see an inflation-adjusted spending that is falling. Near highest level since the 1980s. Oh man, this does not look all that great, right? So what is driving this underlying inflation? Well, it's some things that are not really all that great. Composition of inflation is the most problematic in the US. So looking at Euro, again, we can note that it's energy. So what happens in the eastern part of Europe is going to be very important. But when we look to the UK, the biggest block is still energy. The second one is core goods. When we look forward to the US, the black is pretty big. Black is contribution to change in inflation since January 2021 from services. Services, yep. Those are must-haves, not things we can really adjust. That is not going to be supply-side economics. That is just going to be demand-side. So looking here, we also note that energy is quite high. Food is not really that big of an issue yet in America. Finally, regional surveys show manufacturers see business spending throttling back. What is this? It's a preview for a recession coming from the Fed banks, including Philadelphia, Kansas, Dallas, and Richmond. All right, so all of this is going to be very, very important. And if you're not sure what I'm telling you, it tells you that it looks like we are headed for recession. And one more data point I'll be looking at closely is going to be on Friday at 3:30 when we get the CFTC net speculator positions for oil, gold, NASDAQ, S&P. And I want to see what these big guys are doing. Are they hedging or are they not? So as a recap, we look here to the FOMC meeting minutes coming out on Wednesday, payroll numbers coming out on Friday, but the slew of Fed speakers that is sandwiched before the Fed minutes come out and then also after means that it tells me that they're likely going to need to massage the story that we're going to be hearing when we look at those meeting minutes on Wednesday. All right, trying to get a better sense of what's actually happening here. So Atlanta Fed GDP tracker shows the U.S. economy is likely in a recession. The Atlanta Fed's GDP Now gauge sees the second quarter running at -2.1 after what? A negative decline of 1.6 in the first quarter. That would be a technical recession. So I'm actually not sure when we get Q2 reported on, but if we look here, GDP Now has a strong track record. Again, this is actually one of the Fed's measures. So actually, let's go here. However, the Atlanta Fed's GDP Now measure, which tracks economic data in real time and adjusts continuously, sees second quarter output contracting by 2.1%. Coupled with the first quarter decline of 1.6%, that would fit the technical definition of a recession. That is 2 quarters of negative contraction. So when we look here at the chart, what it tells us is that, again, going back to March or the end of the first quarter to end of June, which is the end of this quarter, what happened? Well, down, 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 down. So that's why we're sitting here at -2.1. And this is tracked in real time. So the forecast that we got in Q1 for Q2 is less reliable than this one. This one is going to be reliable. You can also check the website, atlantafed.org. This is an official website from the Fed. All right, so we talked about this as well. Again, outflows. First time this year so far too. So very notable as we see dip buying happening ever since December and now not so much. Really, really notable to me. Also, as we're seeing concerns about recession, we're also seeing concerns about growth. World Bank growth forecasts have got lowered. They're lowering the forecast for almost everything, right? Only China is actually expected to grow versus the previous consensus. So this is what a lot of people are scared about. It's called stagflation. And stagflation means that, we look over here, it means that Inflation is going, so stagnant inflation. Stagflation means stagnant inflation, which means that we have persistently high inflation, and that is going to be hampering our ability to actually net grow. So we have high inflation, we got low growth, and what does that lead to? It leads to stagflation, which is actually the worst case scenario for us right now, because the US is still the engine of the world. So if we are trying to kill demand, we might be hurting all the world at the same time. So we want to keep all this in mind because as we look at the charts, there is some really important data. All right, so there we go. Remove the drawings. Let's pull this back now. Excuse me. Let's pull this back now. Look at 2 more data points. Fear and greed. We're still stuck inside of extreme fear, which tells me that I think a lot of people are coming to the realization that this thing is real. The bear market is here, recession is coming, and people are feeling the pinch. Man, the data we just looked at tells me that, yeah, people are concerned. I would be too. We also talked here about the heat map. So again, nice day on Friday, but as we zoom out to year to date, the picture looks pretty bleak because there's not a lot of pockets of green here. When we go to sector, right, it's energy, it's healthcare, it's some health, and otherwise, it's not really pretty. It's red almost everywhere, big red. All right, so now with all that in mind, we know the key dates, we know what we're going to be looking for the next month. Next thing I just want to look at is going to be the options chain. And just for time, what I'm going to do is just look at 2 chains specifically. It's important for us to note that next week, because we have a shortened trading week, we're also going to have 3 out of 4 days are going to be OPEX. We're going to have 3 out of 4, which are going to be OPEX or options expiry. It's just an abbreviation. So options expiry, divide the 2 words. That is where OPEX comes from. So Tuesday, Wednesday, Friday are going to be OPEX this week. It's also really important because the last 3 out of 3 weeks, we've actually had expiries on 4 out of the 5 days. One was from a holiday, one was from the quarterly rebalance, and now this week again from a holiday. So as we look forward to, again, I'm looking at the Friday chain because I just care about what is longer dated. And as we look here, what I'm noticing is that, again, July 8th, we're looking at the 16s. And what I notice is that I just want to see who's more motivated here. I see about 40,000 in volume at 380 calls with about $5 in premium, which implies break even at 380.50 for Friday. That's an important number for me. Also note that they're buying a little bit up here at 385, but there is very little open interest. In terms of puts, less volume, and we're noticing that they're coming in here at roughly 375. So a little bit of an edge to the bulls, but marginal. That 385 is going to be an important area too, just because of the premium attached to these options. As we look forward to the July expiry, which is going to be July 15th. And again, this is going to be right around those CPI numbers and right as earnings season is kicking off. As we look forward to here, again, this is where we're trying to find out whether or not the bulls are motivated to buy for 15 days out to July 15 on the 16s. We already know that these puts are gushing all the way down, way below 370, down to, I think it's 350. So now, where is the motivation? Well, we got big stacks on the put side of our open interest at 385. 380 is the biggest stack. We also have 375. In terms of volume, almost only really coming in at 375 here on the put side. In terms of calls, we have some continuation between 380 and 385, but the open interest kind of stinks. There's only 3 strikes with more than 10,000, 375 at 10K, 380 at 50K, and then also 385 at 17K. This does not look very bullish to me because if we're looking at a short-term bottom on the quarterly chart, as we noted before, so let's delete all these drawings now, right? Delete drawings. We look at a 3-month chart, and what we can note here is that there's a lot of potential. So I talked about those 3 levels. I talked about 362. And let's just snap them back here to make sure we don't forget what those were. So first level is going to be 364. Second level is going to be 384. And again, that's because that's going to be us exiting bear market territory, meaning negative 20 off the highs. And then finally looking at 410. So when we look at that options chain, what it tells me is that the bulls don't really have confidence that we can even make it out of bear market territory. Why? 385 is all they're really willing to buy. So how are we going to get up to 410 if no one thinks we're going to get there? Or they're not motivated to buy anything? I don't know. The bull case is getting harder and harder to tell. So again, that's the first thing we want to look at here. Next thing we're going to do now is just actually go through chart by chart on the weekly and just see how things are looking. And what I'm trying to do this week is to provide a little bit of context in terms of I've been away from my screen for at least a couple sessions now where I haven't had my proper setup. And what that means is that I am now coming back to the screen and trying to decipher or understand what is happening. So as I do that, my lines and my charts are not already pre-marked up, which means I want to try to help you in terms of what I am noticing in terms of what is important and what is not. First thing I note here is the price action. So what does it look like? It looks like we want to hit that the 200 weekly, which is our black line at about 350 here, where we find that Fed put after it actually touches. If you remember from last weekend, we were talking about how if we want to avoid 2000 or 2008, it means that we have to test the 200 and then reclaim the 50 here. We have to get back above 438. And if people are already cashing in 11 billion on the first rip, how are we going to make it up to here and exit the contraction, or meaning the bear market, and start another bull market? I'm seeing it pretty hard for us to do that. So the base case here kind of seems like we're going to keep doing this. And that would take us right into earnings season, right into the end of the summer. And then as we start off September here, sell in May and go away and come back on Labor Day. That is going to be right here. That's the Labor Day long weekend. It's our apex at 350. That 200 should curl up, and we should meet it if we continue to hold this blue downtrend. It's that simple. Price action is bearish. What does the volume tell us? We're looking and seeing what is elevated here. We have elevated pockets of red, elevated pockets of red, and one single bar, which is green. What is that? It's bearish. So bearish price action, bearish volume, path of least resistance is where? Probably down. Cool, Justin. That's a great way to start the video. Yes. All right, let's move forward here now. What's also really interesting is that S&P is sitting at roughly negative 20 off the highs, or just below 384. As we look forward here to QQQ, where is it resting? It's resting on the pink line, which is what? Negative 30%. So S&P is at negative 20. QQQ is underperforming by roughly 50% or down by 30. Why does this matter? What's important to me is the candle formation here. So QQQ and SPY have notable divergence. Why? This is a bearish engulfing candle. We're closing near the low of the week. We gapped up, sold off all week, and came back. We got bearish volume here too. There's nothing really going on. So QQQ is underperforming the broader market, meaning S&P. Utilities, energy, and healthcare all outperformed this week. So looking back to S&P, what do we have? We got a higher low, got a higher high, and we got a hammer. What does that mean? Dip buying. And we don't really see that on QQQ. We're only resting on that same low from the May 16th week at 280. QQQ looks soft, is what I'm telling you. Why? Well, what stocks have the highest valuations going into earnings season? Technology stocks. So which ones are likely going to see the most repricing? Technology. Makes natural sense to me. DXY, bull break, right? Back weekly close above 105. That is the first time in quite some time. We have a we have a golden cross or the 50 crossing over the 200 with a W. And I don't think we've seen these prices going all the way back to 2000s. So, yep, we're partying like it's 1990s. Definitely feels like it. VIX got a huge stomp on Friday. We're still in a bullish pattern with a golden cross. It's still in the 20s. Over 30 is going to be where we are feeling like the market is more volatile than normal. Over 30 means risk. Over 40 means high risk. Over 55 and 60 means extreme fear. What's also notable here when we look at the 2-year note and the 10-year note, what do we have again? We got that golden cross. Yes, sir. So again, the things we don't want to see to be bullish on stocks are all telling us that they're forming golden crosses. It is a lagging indicator, but when we see all of these doing the same thing, it's not a great recipe. We can also note that we lost the previous top here or closed below it. And this is a massive stomp for the 2-year here, right? From the high that it staged at roughly 3.5 down to where we are now. It's declined by 20%. Why? The bond market has always led the Fed. The bond market saying, hey, Mr. Fed, Mr. Powell, you think you're going to be able to raise up to 3.5% and 4%? We agreed with you in mid-June. Now we do not. You're going to create a recession. There's going to be stagflation. You're going to actually have to pivot to cutting rates sooner than expected, which means they're going to break something. That's what I see when I read this. I can also note that the spread between the 2 and 10-year, or again, when we have that yield curve inversion, is really close here. It's 5 basis points off. We got 283 for the 2-year and 288 for the 5-year. They're really, really, really close. Again, same golden cross here, also closing below the 2018 high, and it's down about 20% off the highs, but still just below 3%. So the bond market appears like it is still leading the Fed. We're going to jump forward now to a couple more asset classes. Looking at oil, we have an OPEC decision coming in on Tuesday, I believe. I'm paying less attention to energy right now just because we already know the story. It is summer. Everyone's traveling. There's a higher demand, blah, blah, blah. We already know that. Moving forward to gold, what we can note here is that we got a pretty solid push off the 50 weekly moving average, closing the week down by about 1.5%. And the dollar closed up here by about 1%. So gold is actually only underperforming by roughly 0.5%, but closing below that 50 weekly tells me that potentially there could be more downside. Just watching that closely here. As we now look at crypto, again, inversely correlated to gold as a rule of thumb, we are all the way back to our 2018 highs, or that big green line. So no adjustments needed here. We can note that we are already well below our 50 weekly moving average. We got a lower low and a lower high, which tells me that it's bearish. Do we have bearish volume to confirm it? Yes, sir. So Bitcoin appears bearish. If it closes below 19,000 on Sunday, which is going to be today, doesn't look good. As we open up that new week, that would be resistance. If we can't break back above the 200 weekly at 22,500, it's looking pretty bleak here. Already below 20K. Ethereum, same notes. All the way back to not just the 2018 high, but the 2018 shoulder at about 1,000. Already tested it, lost last week's low, lower high, lower low, but bearish volume, and we're already below the 200 weekly. Ethereum is bearish. Bearish price action, bearish volume. I can also note that the volume is ramping here, so people are actually folding bottoms, just like we noted when we saw those outflows on SPY. All right, looking at these trillion-dollar companies, what do we got here? Mr. Tim Apple bounced off the lower trend line here, or the edge of our pennant, and now only just marginally back above our 2020 high here. Apple is still definitely crushing, but what we have to note is the amount of room that we have all the way down to the 100 weekly here. And that round number of 100 would definitely act as a magnet if we do start to fade lower. Again, Apple is the biggest stock in the entire world. It really moves the market. Microsoft, still funneling lower, having a really hard time at that May low here. So, still a dominant downtrend. Volume is much more on par, so I would say more bullish. But again, we have to stop going down and we have to take out that relative low. Looking at Google, bearish engulfing candle here, closing at the low. Volume is elevated, but not red, so it's mixed. Still definitely funneling lower. I'm going to delete this one trend line because now the dominant trend is just down. Very easy to see here. We're also right around our 2021 highs, so actually saving higher highs than other stocks. Looking at Amazon, 3% rip on Friday, bounced again off of our 2018 highs. So Google is bouncing off 2021 highs. Amazon is now only able to bounce off 2018 highs. 3 years earlier. What does that mean? Those are pre-lockdown numbers. So it's really stuck here. And I'm not sure exactly where it's going to go. 102.5 is roughly that lower area. And then 110 is going to be our roughly February of 2020 high. So that is just before we had that drop everyone knows about and then the rip higher. So it's back testing 2020 highs. Looking at Tesla. Tesla is also below the February low. It could stop going down by just closing above 700. Volume is actually quite low compared to the ramp up, but that's because we're still about 7-8 times higher in terms of price, which means that every share is now actually trading 7 to 8 times more dollars, even if we're not seeing total shares increasing. Meta or Facebook. We note that dip buyers have been coming in by these green bars here. Is it enough? Nope. Lower lows and lower highs. It's losing everything. It's back to 2017 levels. With Sheryl Sandberg leaving the company, this looks pretty bleak. We still technically have a low, higher low, but that's about all we have. Nvidia, yikes. That is a big bearish plunge. We noted that, I believe it was this week, that Intel is saying that the US government is stalling out on producing that chip plant, and that's part of the reason why we're probably seeing some negativity here on these stocks as well. And again, what is NVIDIA really doing? Well, crypto. So really elevated volume, Nasty price action, negative 15% of the week. That does not look good. Now, moving forward to these ETFs. So going a little bit faster now, the Dow actually still has dominant green volume. As we fade lower, red volume is coming in, but it's not nearly as big as these green bars. So I would say this is actually a little bit bullish. And we actually have a higher high, a higher low, sucking up more on this hammer and actually exiting the demand zone or the green box here. So Dow does still look stronger than the S&P. Technology or XLK, again, this is less waiting for Amazon and Tesla. And what we can note here is just that it's right back to that summer 2020 high or the green line. Bearish engulfing candle looks just like QQQ. The Russell, oh God, right? At 172 or 171, it is just barely holding on by a whisker to the 2021 highs. And 2021 high here, 170.50. Yeah, so the challenge here is that if it falls below, these 2018 and 2020 highs are now going to act as resistance, which means that it's probably going to have a very hard time getting up. If it can't do it now, I don't think it's going to be able to. It's also already below the 200 weekly. Most are currently not. So the Russell is currently a leading indicator of where the rest of stocks are going to go. Remembering that the Russell also has 2,000 stocks, which are small cap companies, and small cap companies generally compete on price. A lot of the large cap companies, including like Apple, Microsoft, blah, 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 they don't compete on price. They compete on services. So that's important. And again, also when we note that when we note the inflation coming in, it's from services. Why? Well, because these companies have pricing power. ARC, dumpster fire, right? Yeesh. Not a bearish engulfing candle, but we have, let's actually double check, 459946, bearish engulfing candle. It's just starting to go sideways. What this looks like to me is a psychology chart where we're starting to enter the period of sideways frustration. We've really been going nowhere since we formed our capitulation low on May 9th. So this is almost a little bit more months later. We're going nowhere, and it's deeply oversold. So I don't really know what's going on here. NYA already technically hit the 200 weekly moving average. Backtesting 2020 and 2018 highs. It looks okay. I'm going to flip through the last ones here a little bit faster just to try to end the video. So let's get through here. RSP looks just like SPY. Higher high, higher low. Gap's been filled. It's a big week here. Volume's also falling off, which means that we're probably going to see an explosive move when volume starts coming back in. So as those bars start increasing, we're probably going to see an explosive move. I'd be leaning on down, but right, flip a coin. I don't know. XLF, marginally higher lows. This tells me that people are scared about a recession where we're going to see bankruptcies rise and these banks are not going to be able to afford the loans they underwrote. We're also backtesting 2020 highs already here. XLV, nice week, right? Big, powerful move. Closed above last week's high, actually closing green by roughly 0.4. Just below the 200 weekly, this looks pretty good. There's not a lot of pockets of strength, but XLV looks pretty good. XLE, closing the week up 1.3, also looks okay. All green volume here as well. In a bullish pattern above all averages with a golden cross. Generally pretty bullish. Utilities, woof, look at this week, right? 4.12%. Reclaiming 2020 highs. Back above the 50 weekly. And elevated volume, which is mixed. So I would say XLU actually looks like the strongest chart I've looked at so far. And generally speaking, utilities will be inversely correlated to risk assets, which means when utilities go up, we're generally going to see technology go down, which we did. Emerging markets, going nowhere in a hurry. And then China, trying to form some pressure here. It's definitely going up. Since May, we've been forming an uptrend here. And again, it's also back above that 2020 low here. So taking out the relative low, let's see if we can make it to the next one here at roughly 38. But first of all, getting through that 50 weekly. So let me know in the comment section if you like this video. And if you want to watch more in terms of a deeper review with my normal setup, I encourage you to watch the video that will come up here in a moment, which is going to be last weekend's review. Otherwise, I thank you for watching, and I very much look forward to seeing you for our regular streams this week. Thank you for tuning in, and good luck.